It's time once again to focus on your money. It's Wealth Wednesday. Brian Widmer from TD Wealth is here today. And we start with the Bank of Canada, who held rates earlier this month. What does that mean for the economy that they held the rate?
Well, I think it means that we have seen a slowing of inflation. Basically meaning that these higher interest rates that we've seen over the last year and a bit have been successful in slowing at least many aspects of the economy. I mean, the part that remains to be seen and nobody knows is this exactly where the bank wants to be at this point? Mm-hmm. Is it a short-term blip? Or potentially have they gone too far, too high of rates for too long, and potentially pushed the recession onto our plates? Only time will tell, but for what it's worth, most economists are calling for no recession or nothing significant.
Okay, so we hear a lot of stock market analysts talking and making predictions, but how reliable are those predictions that they're making?
Well, I mean, first, investors and business media, all of us, we sure love to idolize a past performer.
Yes.
It's human nature. We keep looking for that big prediction that's going to help us hit a jackpot or maybe protect our savings some. You might know the name Michael Burry. If not, you probably know the book or the movie The Big Short that he inspired.
Yes, I know the movie.
Exactly. He correctly called the 2008 housing crisis. He recently made a $1.6 billion short against U.S. stocks. I mean, that is a startlingly large bet against the economy from a very, very famous investor.
Yeah.
But that said, we idolize past performance. He's called for many incorrect corrections in the past as well. So I think what investors should be thinking about is there any value in these predictions? Several research groups have studied the accuracy of market professionals over a long period of time. They all seem to come up with the same answer. They've gathered thousands of forecasts from dozens of the gurus and typically found that just under half were accurate. Not bad, but just under half were accurate. From the other side of that is you would have been better off flipping a coin, and we should probably focus on quality in the long term and pay far less attention to these short-term predictions.
Okay, so trying to boil that down now to the average Joe and Jane. What do you suggest the average investor does in a situation like this?
Yeah, well, it's what nobody wants to hear because it's boring and it's not entertaining.
Bore me, don't be entertaining.
You know, really investors need to start by building a portfolio that not only looks into what rate of return am I trying to achieve for myself, but most importantly, how comfortable am I with the downside that comes with that. From there, you've got to build a well-diversified portfolio that doesn't factor in any of these grand predictions of what might happen in a black swan event for the economy or for an individual stock. And you know, whether you're a growth investor focused on AI or semiconductors, or a value investor focused on railroads and banks and collecting dividends, just maintaining that investment discipline through several market cycles almost always ends up with the best performance.
Well, you've certainly given us a lot to think about. Brian Widmer from TD Wealth was here today. That's Wealth Wednesday, and that's Chat News at noon for today. Thanks for being here today.
Thank you so much.
We're back at 5 with all the latest for you.